Welcome back from Thanksgiving break, everybody. And here we are, episode 12 of The Rent Roll, your podcast on all things rental housing. I'm your host, Jay Parsons. And today we'll be talking to John Drachman, the co-founder of Waterford Property Company. And we're having a fun conversation, kind of headlined around the debate of Texas versus Southern California. John's one of the few people who invests in both. And so this isn't an either or, this is a both and, but there's important nuances that goes into operating and investing in both. So we'll be talking to John about that. And also, even before we get there, I'm going to try to do one of my favorite things, which is some myth busting, talking about why the haters for both regions tend to be mostly wrong, but also how the dynamics between those two markets, those two regions have dramatically changed over the last few decades. So we're throwing some data at you and then having a great conversation with John, aka Dr. Doom. I'll let him talk about how he got that nickname in a bit, but that's a fun story. So I'm looking forward to that conversation with John. That's going to be a fun one. Before we dive into the data, I want to give a shout out to our sponsor, Madera Residential. Check them out at maderaresidential.com. And let's jump right into it with here's a chart. All right, so I got 4 charts with you for those of you who can see the video, and if not, I'll talk to you about it. First one, again, the theme is Texas versus Southern California. So obviously compare the two, the SoCal backers say, hey, Texas builds too much. And so here's that chart. Texas does build a lot more than Southern California. I'm going to compare for here the under construction rates. That's total number of units under construction at any given time compared to the total number of existing units in that market. In this case, the 5 big Texas markets, Dallas, Fort Worth, Austin, Houston, San Antonio, versus the Southern California region, which of course is LA, Orange County, San Diego, Riverside, and Ventura County. So sure enough, Texas does build a lot more, about 2x faster rate on average. Typically Texas is building 4 to 6% of its existing stock versus 2 to 3% in SoCal. At the peak in this cycle, Texas got to almost 9% of stock. Of course, it's dropped a lot since then. If starts have plunged, we're down to already a more normal 5.2%, which, believe it or not, is more similar to what we saw prior to the pandemic. So that slowdown's come fast, but it won't translate to slower deliveries until later next year, but it's happening. Of course, these stats do vary a lot by MSA. I'll give you one guess to what market tends to build the most. All right, you probably already know the answer. It's Austin, of course. The average of construction expansion rate since 2010 is 8.2%. So that's well above second place Dallas at 5.2%. But even Austin aside, Texas, of course, builds a lot more than SoCal. So one narrative out there is that because Texas builds so many apartments, it must underperform on revenue growth. I'm sure everyone's heard that one before. Another narrative is because Los Angeles particularly, but Southern California more broadly, has seen negative migration trends. It must underperform on revenue growth. So, those are the narratives. And in both cases, they're pretty much wrong. Over the long term, as you'll see from chart number 2, if you can see it, they actually produce pretty similar results. This is lease revenue growth, or the year-over-year change in revenue per available square foot from RealPage Marketing Analytics. And what you'll see is since 2010, the Texas average is 3.8%, Southern California average 3.6%. So basically the same. Even if start difference, you do see different, start differences. We do see those start differences at multiple points in history. Going back to the early 2010s, coming out of the GFC, Texas outperformed by a wide margin. And then the second half of 2010's decade, Southern California finally got some momentum, and so SoCal outperformed through most of that time period leading up to the COVID period. And then, of course, pandemic hits. Texas outperforms through the pandemic and in the inflationary period that followed in 21 through most of 2023. But now it's flipped again. SoCal's having its moment as the big supply wave puts downward pressure on rents in Texas. And that's probably going to sustain through 2025. So yeah, Texas builds a lot more apartments, but also has a lot more absorption. Lots of people coming in. And the Texas haters always kind of skip that part about high demand. They just always talk about supply very dismissively. Remember, it's supply and demand, not just supply. You got to have You got to talk about both in balance to each other, supply relative to demand. So you can build a lot more, but if you also absorb a lot more, it's going to balance out. Now, of course, on the flip side, in SoCal, the haters talk about out migration, but they don't talk about the structural undersupply of housing, particularly higher quality investment grade housing. And so those two factors, the undersupply of housing in Southern California versus the incredible pace of absorption in Texas, on balance, over a long period of time, they tend to wash each other out. So at any given point in time, one region may outperform the other, but over longer periods of time, it's actually pretty similar historically. So unless you're really good at timing markets, there's really not that big of a difference over the long haul. Now, by the way, this stat also varies a lot by MSA, no surprise. Going back to 2010, Austin and DFW have been the top Texas performers right alongside Riverside and San Diego from SoCal. Houston and Los Angeles have been the laggards for their respective regions, and right in the middle are Ventura County, Orange County, and San Antonio. All right, so how does all this impact capital allocations? Well, they've gradually shifted out of Southern California over the last couple of decades, more toward Texas. This chart, if you can see it, is showing you the share of acquisition dollars going to Texas and Southern California since 2001. This data is from MSCI, Real Capital Analytics. So this is the total. This is the share of total U.S. multifamily acquisition dollars going into Texas and Southern California. So back in the early 2000s, prior to the GFC, SoCal commanded 18 to 20% of all U.S. apartment acquisition dollars. Coming out of the GFC, it hovered in the low teens. In 2023, it was down to below 9%. It's come up a little bit here in 2024, but it's hard to read too much of that given the very low volumes this year. Now, not surprisingly, it's the inverse in Texas. Texas commanded a low teens market share through much of the 2000s, jumped into the mid-teens coming out of the GFC, briefly hit 20% in 2014. It's been the high teens since then. Saw another little pop after COVID, but it's moderated a bit since then. All right, so how does that translate to cap rates? Well, the spreads have tightened, but they're still there. For a couple of decades, the spread was 100 to 150 bips premium to buy in SoCal versus Texas. It started to change in the late 2010s, really 2018, 2019, even prior to COVID. Today, it's about 40 bips. So high quality Class A apartments, you may be trading in the low to mid fours in SoCal today, maybe a little bit higher in some cases versus mid to high fours in Texas. So investors buying in SoCal are still paying a premium relative to Texas in order to get in there. And in fairness, some of that's going to be due to the property tax advantages in California with Prop 13 versus the higher property taxes in Texas, particularly Texas being a no income tax state that put more emphasis, more need on the property taxes. So it's hard to directly compare them for that reason. But again, bottom line is you're still seeing a premium for Southern California versus Texas. Now, of course, these are just four charts, four things I've talked about. We're just scratching the surface and comparing SoCal and Texas. This is by no means comprehensive. There's other factors too. I mean, one additional one is obviously the regulatory environment. Historically, investors would argue that the regulatory environment, the tougher regulatory environment, was a tailwind for places like California because it provided a bigger barrier to entry, bigger barrier to construction, meaning lesser supply competition. But today, it's changing. It's not just about supply. In fact, the barriers are now hitting the operational side, and that impacts investors' abilities to achieve pro forma. That's especially been true in Los Angeles, both the city and the county, where we saw those very extended eviction moratoria structured in a way that essentially made rent payment optional for several years. And in turn, LA is still having challenges with bad debt and with lower collections. And many apartment REITs, we talked about this in the web on the podcast a couple of weeks ago. Many apartment REITs are still talking about deeper bad debt challenges in LA versus other parts of the country and even other parts of SoCal on their recent earnings call. Camden CEO Rick Campo, who of course has a big Texas presence, of course, as well, he's been particularly sour on Camden's Los Angeles and SoCal portfolio. So that's a topic I'll be talking about with John Drachman later in today's program, since he operates in both, really kind of diving into what are the operational differences between those two regions. But even LA aside, it's important to note that other parts or I should say LA aside, it's important to note that Southern California includes a lot of, not just counties, but a lot of individual cities. And some of them have more politically stable environments. Some of them are better and more collaborative to work with, which in turn creates a more stable operating environment. So you can certainly make a case for loving Southern California outside of maybe LA. Maybe some groups are going to just redline that one, maybe not. Or maybe even making the case that eventually stability returns to LA, given the long-term appeal of that city and the long-term structural undersupply of that market, and especially if you could find deals at an attractive basis. So we'll see. On the other side, though, the Texas backers, the data is quite clear that over the long term, high supply is just not that albatross that the haters make it out to be. It certainly does impact short-term performance, such as right now, but over the course of time, it pretty much balances out thanks to these robust demand drivers that we see. And with construction starts now plunging, of course, there's a bull case to be made for Texas over the next cycle as supply thins out. So, remember, ultimately, I'm a big believer that supply risk tends to be predictable and temporary. Policy risk tends to be unpredictable and almost permanent. So I think that is an important distinction, but that doesn't mean you can't be successful even in a more challenging, politically challenging environment. So, I'll talk with John about this as well, but I think we're really seeing a shift where places like Los Angeles might be less institutional because of exposure risk and reputation risk in that market, but that could be creating more opportunities for smart, sophisticated local and regional players who really know those markets. So remember, just because it doesn't fit for some doesn't mean it doesn't work for others. There's still opportunity. You can be successful in any market with the right strategy, the right location, et cetera. So anyway, a lot of factors that go into all this. Oh, and by the way, I started on policy risk. I should have once again commend voters in California for once again, for the third time, overwhelmingly shooting down rent control expansion across the state. That happened back in the November election, and that certainly would have been disastrous, not just for investors, but for renters as well, had that passed. So that does provide a little more stability cushion for California. Next up, rental housing trivia. All right, so today's question is, which SoCal metro has the highest average apartment construction rate since 2010? Is it A, Los Angeles, B, Orange County, C, Riverside, or D, San Diego? So take a minute to think about that, and we're going to return to that in a minute. But first, in the news. This one, we review headlines touching on rental housing issues. First one comes to the Wall Street Journal. America's biggest apartment owner takes a leap into modular homes. Greystar to open its first U.S. modular project, a 6-building apartment complex in Pennsylvania, and is building 6 more. All right, so this is an interesting topic. Obviously, modular construction has been around for a long time. Starting to get more focus given the high construction costs and also rent affordability challenges. So starting to look for, hey, we need to find some creative solutions. And modular has been one of those things that's kind of getting cool again. And seeing Greystar jump into it is obviously an interesting sign of that. So how is Greystar making it work? Well, Greystar, first and foremost, they built a modular home construction facility, a centralized site in Pennsylvania. I believe it was about 80 miles or so from this first site, which is right outside Pittsburgh, suburban Pittsburgh, small town of less than 6,000 people near the Pittsburgh airport. But it's a pretty sizable project. And a couple of things that were interesting is, number one, location really matters. You got to be close to that centralized site because transporting these big modular homes is very complicated and expensive. And second thing that I think was important is obviously the building codes, particularly around aesthetics, can vary a lot by city. And so you got to find locations where it can actually work out, particularly get the kind of scale you need for modular to make sense. So that's why I think we're going to see it either in smaller cities and not having many regulations around construction, or in very forward cities that make exceptions to incentivize modular. So very interesting story here. Ultimately, I don't think this is going to be the next big thing. I wrote about this on LinkedIn recently. It's very interesting. I think it's an interesting niche. It's going to work in certain spots. But ultimately, the one thing the article talks about, and you talk to anybody in modular, they'll tell you this as well, is you really don't see great cost savings. Even though it's quicker to build, which obviously can be very good for investment returns, that's an advantage. It takes fewer workers on site, but the overall costs aren't that dramatically cheaper. The one study said it's 5 to 10% cheaper. Greystar said they think it's about 10% for this particular project. But you consider, the kind of potential impact there. Well, 5 to 10% cheaper doesn't make your rents dramatically cheaper, and so you're really competing with the same product in terms of traditional construction. And in many cases, like Greystar has an advantage because they own the construction manufacturing facility as well as the apartment project, so they're able to get some savings there. But that only works within a certain radius. In Greystar case, I think it's about 600 miles their radius for construction. So you're going to have to see bigger savings for this to really scale. Ultimately, it's a good emerging niche, but probably is not going to take over. Next headline comes from the Texas Tribune, and really you could pick your source for this headline. We see this all over. It's about our potentially next secretary for the U.S. Department of Housing and Urban Development, for HUD. Trump nominates the former Texas lawmaker Scott Turner to lead HUD. Turner served in the Texas House for 4 years and also was executive director of the White House Opportunity and Revitalization Council in the first Trump administration. Additionally, Scott Turner most recently has been working as a chief vision officer for JPI, the big Texas-based apartment developer. And by the way, just like our guest today, John Drachman, JPI is a builder in Texas as well as Southern California. So anyway, Scott, I did a little bit of research here. Scott is, if he goes into office as Secretary of HUD, if he's confirmed by the Senate, he will be the first Secretary of HUD that comes in with a prior background in housing development from the private sector. So that could be quite significant. In fact, interesting little trivia here. He'd be the second former NFL player, but only the first with a background in private sector housing development, especially rental housing, apartment development. So that's pretty cool. So anyway, I've met Scott a handful of times over the years. Great guy. And in my book, you could not have found a better person more qualified to lead HUD. And just first and foremost, an outstanding human being who loves people, genuinely wants to help people in need, and understands the industry, understands what it takes to build housing. So I think this is a home run, or I guess Scott's an NFL guy, so I should call it a touchdown. But a great pick, and I hope the Senate gets him confirmed. Third headline comes from NBC News. Private equity landlord screening process discriminated against renters, lawsuits contend. Inaccurate tenant histories can add to the many woes renters face finding homes. All right, so, there's been a lot of discussion about this. Rapid innovations and leasing fraud. We see synthetic and stolen IDs. That's costing property owners dollars. It's artificially limiting availability. That, over time, puts upward pressure on rents. So screening is critical for resident safety, too. You want to get it right. It's a tough topic, but you want to get it right. Everybody wants to get it right. It's just a lot more complex, and sometimes these headlines make it out to be. And I'd love to see more focus on really rooting out criminal fraud and identity stuff, the stuff that's a lot more sophisticated than just a fake pay stub. And that would make it easier to identify and help, renters who are in real need as well. So that'd be a real win for honest renters and for property owners if we can solve that. But in the meantime, it's a real challenge because, ultimately, again, you want to get it right. Next up, good question. This would be a question that we get about a hot topic in the news of late. And this one just stems from one of the news items we just talked about. What should be the priorities for the next HUD secretary? Well, first and foremost, let me say this. I've been asked this a few times now. I want to tell you, I think Scott Turner has a great handle on this, especially given his background. But a couple things come to mind real quick. I think, just my personal opinion, I would not be surprised to see him focus on expanding and extending opportunity zones. That's been something that he helped launch in the first Trump administration. It's been a massive success in terms of spurring apartment development in these spots in opportunity zones that wouldn't otherwise have been built. So I think we'll see more of that. Another thing, in just general focus on removing barriers to construction. I think the more you can help cities and states do that, since a lot of this is local, that's going to matter. Maybe also working with freeing up some federal land for housing. Those are all positives. The other big thing I think facing HUD is, and really the federal government more broadly, is how do we, I talked about this in the previous podcast, how do we focus on preserving naturally occurring affordable housing, and even tax credit housing. And by that I mean not just preserving the rent affordability levels, but preserving the buildings themselves and creating and expanding programs that make it easier to bring these buildings up to modern safety standards and code and livable conditions, while preserving the affordable rent. So I think that can be it's a real challenge, something I hope that we can address as a country over the next few years. Next up, let's return to our rental housing trivia question of the week. And today's question was, which SoCal metro has the highest average apartment construction rate since 2010? Los Angeles, Orange County, Riverside, or San Diego? And if you guessed Orange County, you are correct. Orange County is actually, might surprise you to know, it's just barely beat out San Diego to be the top construction spot of the last 14 years or so. Now, if we went back further, Riverside was a hotter construction market, but really never got going over the last decade or so, like you might have expected it to. Especially, it was a market that just took some time to really recover out of the great financial crisis, and just never got a ton of investment dollars for construction after that. But certainly has been a strong market. As I said earlier, it's been right alongside San Diego, the top performing market for revenue growth over these last 14 years for Southern California. That's going to transition us into the interview, and I'm pleased to welcome in my friend, John Drachman, the co-founder of Waterford Property Company. All right, now welcome to the interview segment of today's podcast, and I am thrilled to be joined by John Drachman. He is the co-founder of Waterford Property in California, and also an adjunct professor at USC. So, John, thanks so much for being here.
Thank you very much for having me on, Jay, and I'm really looking forward to this discussion today.
Now, if anybody doubted where you're located, they just look behind you and see the jersey for the late great Kobe Bryant.
Kobe Bryant jersey, Southern California.
Yeah, that's a good thing to have in the office there. All right, so John, you and I got to know each other over LinkedIn, and quickly came to know you as Dr. Doom for sounding alarms back in 2022 around those value add buyers, peak prices, floating rate debt, and you were largely right. And that's really become perhaps the only deeply challenged segment of the apartment market so far in this higher rate, higher supply environment. So first of all, how'd you get the nickname? And second of all, what did you see back then that others did not?
Yeah, it's an interesting story. So it was really the spring of 2022. You know, our firm had been focused on commercial properties, mostly multifamily in Southern California. And in the spring of 2022, I have a very good friend of mine who we were actually playing golf together. And he was talking about these new developments he was pursuing in a Sunbelt market, and that might be called Las Vegas. And so we were talking about these deals, and he was mentioning to me, he's like, I can't believe these prices people are paying for Class B and C apartment buildings. It really makes a lot of sense to develop in this market, because if people are buying at these prices at or above replacement costs for these older vintage assets, if I could build new product there, I think I can really do well.
Yeah.
And he'd actually sent me, I was interested, so he sent me a list of comps, and I had not been tracking sort of the Sunbelt multifamily markets that much. I knew there was a lot of activity and there was a lot of sales going on. But when I saw these comps, I could not believe it, because the cap rates were sub 4%, in some cases sub 3% for 80s vintage projects in a market like Las Vegas, where an 80s vintage project is really old and really tired.
Yeah.
And so I dug into it more, and I was like, who are these buyers that are doing it? And I started looking up some of these buyers on my own just for fun. And when I started Googling them and figuring them out, I actually was able to get, because a lot of their debt was done in these CLO structures, or these kind of public structures, background on the debt that these groups were using to acquire these deals. And when I saw it, recognizing at the time interest rates were really rising, I thought there's no way that these deals could survive. And I came back to him, and literally a couple weeks later, I'm like, I don't think you should invest in Las Vegas. I don't think you should look at these development projects. I think that market is going to be really challenged, because I think all these sales comps are garbage, and all these groups, as interest rates rise with all this floating rate debt and how they structured it and how aggressive it was, it's going to fall apart, and I would be really careful. And he literally said, "Wow, you sound like Dr. Doom," which, was a famous person from the GFC. That was one of the people who had sounded the alarm bells in the GFC.
Yeah.
And we started sharing stories about it. And I kept telling him this over the next month. I think it was sometime in the summer of 22 where I joked with him. I said, "I'm going to make a post about this on LinkedIn because I feel strongly about it. I'm going to call myself Dr. Doom." And I did it in very tongue-in-cheek fashion.
Right.
But it was really sort of raising the alarm bells on these deals going, I don't see how these deals survive. And just based on the nature of how aggressive they were bought, how high a price is, the assumptions on rents, the assumptions on occupancy, the assumptions on debt and where cap rates were going. And so I kind of self-gave my name that. He would joke that he gave me that name. And yeah, I was kind of off. Away we went with that.
Yeah, and again, you weren't wrong, and I think it's also kind of fed into the construction story where so many groups are putting money into new construction because of the issues you just mentioned on pricing for older assets. So let's fast forward to today. You know the data, starts are plunging. Industry consensus from really local groups to up institutional groups is that reduced supply in 26-28 is going to lead to improved fundamentals. And so are you still Dr. Doom on multifamily? Are you buying into the view that we're about to see a more favorable supply-demand environment?
Yeah. So, we as a firm used to do a lot more on the commercial side, specifically office projects. So I would tell you, I have Dr. Doom on office projects for sure. Yeah. That's a whole different conversation in a very challenging market. On multifamily, I think it's going to be a case there's going to be winners and losers. So no, am I, overall negative about the multifamily markets? No. I think the other thing that was going on, Jay, and you and I talked about it, is, towards the end of 2022, absorption was really negative. And you saw all this new supply that was going to get delivered in 23 and 24. That's probably when I was the most negative. Now, where I was wrong is those absorption numbers quickly flipped. And we've seen really strong absorption, specifically in Sunbelt markets, over the last 18 months. Really in 23, specifically in 24. I think 24, based on some of the stats I've read from you, is going to be really strong absorption. And as this I tell my students at USC, real estate is about supply and demand, something that Sam Zell used to talk all the time about. And I think sometimes people get too lost in the minutia of capital markets. When you look at demand, which I think is always important, demand is incredibly strong in many markets for multifamily assets. And so then you put on the backdrop of we will have a supply cliff. Now, I actually think it's probably going to be more short-lived than people think, just based on the capital that's out there and where capital needs to go and the changing capital markets for real estate, which we can get into. But there will be a cliff of a period of 24 to 30 months, really starting in the middle of next year, where you're not going to see a lot of new supply because nothing was really starting the middle of last year, the beginning of last year. And so I think you can make a very optimistic case for multifamily in many markets around, the country. We're in Southern California, and I think that, multifamily has actually performed very well, or traditionally does very well because we do a terrible job at adding new supply. But I think even in markets with high supply, Dallas is a market that we've entered into. You can still make a very bullish case for why you'd want to be investing in the multifamily in those markets. And to me, it's because of the demand. The demand is really strong. And I think in real estate, investing into markets where there's strong demand, irrespective of supply, is smart. And I agree with a lot of what you say, Jay, where yes, you can say a market is maybe oversupplied, but realistically, these are short-term blips. We're undersupplied in housing in the United States. And so I am not on the multifamily side as Dr. Doomish. That being said, those groups that I mentioned that did those aggressive deals in 2021 and 2022, yeah, they're up the creek without a paddle, so to speak. Those deals, you're seeing them get foreclosed on. You're seeing massive challenges. And that's because the structure of those, how much they paid, the type of debt they used, it was just bad timing.
No, I completely agree. All makes sense. And yeah, you and I talked about this before, but it always drives me a little crazy when people just take this tiny part of the market and they try to extrapolate it and think all multifamily is doomed.
Yes.
So but you and I are aligned on this. So you mentioned California and Texas,
Yeah.
and this is one of the things I love. I'm just fascinated by it because
Yeah.
I'm a nerd for rental housing investment,
Yep.
and I know people like you do all over the country. I
Yep.
don't know a lot of groups that are in I know California groups, I know Texas groups. I don't know a lot of groups other than some of the big national players, of course, who
Yeah.
really do both. And
Yes.
so I want to know about the differences. But first of all, before we get into that, tell me what brought you into Texas from California to begin with.
Yeah. So, I'm born and raised here in Orange County. So is my business partner, Sean. We've been together. Waterford started in the summer of 2014. And I have a little experience in Arizona. And when we started, we were primarily California focused and really split in California. And we do everything from affordable housing development to workforce housing investments to, market rate development and investing. So we've kind of done it all on the spectrum of the multifamily sector. And I think we got really active in California in creating workforce housing through public-private partnerships by acquiring market rate housing using various forms of tax exemptions, creative financing, municipal bond financing, various structures. And so we got really active in that, really kind of the start after COVID. We have been active in the light tech, affordable housing development space using 4% tax credits. And so through that knowledge and some of our market knowledge, we really expanded when a couple of programs got created in California to create true workforce housing. When I say workforce housing too, this is housing that is rent restricted and really focuses on people who make between 61 and 120% of average median incomes. Because these are people who make too much money to qualify for a traditional, what I would call capital A affordable, but are not making enough to afford market rate housing, especially in places where they're working, right? Close to where they work. And Southern California is a great example of this, where rents have run and it's incredibly expensive to live here. Through that knowledge and skill set, that's what really brought us to Texas. And really, it helped introduce us to Texas because Texas has some very similar public-private partnership programs to create workforce housing. And so us being active here, we were able to really use the specific knowledge of what we had done in Southern California to take it to a market like Texas because we were sort of very laser focused on what we do. So as we moved into Texas, it was really the specific knowledge of how you create workforce housing, how you asset management, and how you do it.
So now let's get into the fun part. So you're operating in one of the most highly regulated states in the country, if not the most. I guess you could argue New York or California, and then Texas, which is kind of the opposite. So tell us, what's the biggest differences in investing and operating in these two states?
It's a great question. And I think what we've learned is there's pluses and minuses to both.
Sure.
I think in California, as you mentioned, we're highly regulated. I think, especially after coming out of COVID. Now, it looks like Prop 33 is not going to pass, which was the removal of Costa-Hawkins, which I know you talked about on LinkedIn. So that overwhelmingly got defeated for the third time, which is a great thing. But California has, we had some of the longest eviction moratoriums as it relates to COVID. It's always been a very highly regulated market. We actually like that because what it does is it means you have to be very smart and sophisticated to be able to understand how to transact in these markets, how to work within that regulatory framework. And so it makes it harder. As I tell a lot of my students, that's not always a bad thing. Sometimes things that are harder can be better to do because it can create more moats around those sort of business lines, right? And if you understand the regulatory environment, if you understand the political environment in California, yes, it's harder to get things done, but you can still get things done. So we've actually, that's one of the reasons we like it. The other flip side is because of that regulatory environment, it's very hard to build new supply here. So when you look at the submarkets of Southern California in particular, many of these submarkets, San Diego, Orange County, Ventura County, they performed very well coming out of COVID. LA has had its challenges for sure, but still LA, I think, is 5.2% vacant, right? And so I think you find a market where because I always say we suck at building new supply, it's a technical term, and we still have people who want to live here. It means that these markets from a supply-demand fundamental standpoint, you have some built-in protection. The irony is California actually protects developers and investors very well, right? It's sort of this kind of grand irony. You fast forward and look at what we're doing. What's that?
Can I ask you a quick question, John? So I'm curious, you alluded to this. Like I've seen like whether it's the REITs, other private groups as well that have said, hey, we like Southern California, but Los Angeles is almost off. I mean, almost being redlined.
Correct.
Do you see it that extreme?
Oh, yeah. I mean, if you look at California, or you look at, the city of Los Angeles, for instance, when they passed this Measure ULA tax and the things that they've done in an effort to protect renters, I think that I can understand why institutional landlords are turned off by all of this. That being said, when you look at the pricing of where some of these assets are trading for, well below replacement costs, we actually think there's some really great opportunities in a market like LA, because again, when you look at the supply-demand fundamentals, they're still strong. And it's going to be basically, they put a moratorium on new development because it's really hard to build because it's so expensive to build here. And so, those supply-demand fundamentals are still going to outweigh it. I think, but you have to be where it's harder for a big public REIT is traditionally, they're not going to be great at being the group that follows all these specific regulations, right? So you really need on the ground groups who understand what's going on, who have relationships at a political level, understand the regulatory agreement. And I can understand why a big public REIT would go, this is hard. Why don't we just go buy apartments in Texas? Right? Well, we don't have
but it was his development, but also I think the biggest challenge they've had is just not being able to collect rent.
Well, correct. Well, I mean, the most interesting stat, I think you said this once on LinkedIn. LA County had the lowest bad debt out of any county in the United States going into COVID. You fast forward 3 years later, and I think we were number 6 in the amount of bad debt, right, that we had. And at one point, we were number 1. So it completely reversed. And so that is been a huge negative for a lot of investors because the eviction moratoriums ran way too long.
Yeah.
That being said, on the ground, because we have a lot of units we manage in our portfolio in LA County, it's gotten significantly better. There's still some persistence of it, which is kind of annoying, I would say. But in many of our projects, it's gotten significantly better over the last year. So we tend to see this as a trend, again, that it sort of was COVID related and it's starting to pass. The interesting thing, Jay, I think you've seen this bad debt trend popping up in other areas. I know it's been heavily prolific in Atlanta, Dallas, Phoenix. Some of these Sunbelt markets have seen more bad debt way past COVID. And so it's now kind of filtering out a little bit. But yeah, it has and was an issue. What we're seeing in our portfolio, though, specifically over the last 12 months, it's gotten significantly better.
Yeah, well, that's good to hear.
You have a question about, so why would we go to Texas, right?
Yeah, let's talk about Texas, yeah.
So, by going to Texas, we obviously love the fact that from a business-friendly standpoint, it is a lot easier to do business there. Even dealing in the public-private partnerships that we deal with, we just find that there's more of it's a bit easier to get things done. It's not easy by any stretch of the imagination, but it is a little bit easier to get things done. And maybe there's a whole host of reasons for that, but it is. I think the flip side that we're seeing, in our portfolio, though, is there's a cost to that, is that it is easier to develop, right? And in some of these markets, specifically Dallas, where we've been investing in, there is a lot of new supply that's coming in. It is increased, vacancy rates. That's not something that we ever have to worry about really in Southern California. We laugh about that. Where it's like, oh, you're buying an apartment building. What could be built next door to you? You're like, nothing, right? So, in Texas, you have to really think about that. And you have to really be mindful that are you investing in the right areas? Are you investing in areas where that's where the people want to live? And what does that new supply outlook really look like? And so it's something to be very mindful of. And so I think there are some differences there. And I think what's unique too is the amount of capital that wants to be in a market like Texas, specifically Dallas. It's plentiful. ULI just came out with the report that said that's the number one market, right, for their emerging trends for 2025. And my opinion, it's a market a lot of people want to be in, and so it's extremely competitive.
Yeah. No, I agree. It's just it's interesting to. What about on the operating side? I mean, you had any kind of similar challenges or different challenges than you do in California?
The irony is not really. No, like some of
Yeah.
the, some of the challenges we deal with in California, we see in Texas related to security, right? We've seen insurance costs in both markets, and
Yeah.
incredibly high. Um, but overall, not really. That's what's kind of interesting from an operating perspective. There's not that much differences that we've seen.
Yeah. Yeah. That's good. So let's what about, one other question on the way is just what about the rent collections? Has that been a challenge in any parts of Texas?
Not really, no. We've seen it. It's pretty much like you're always going to have a little bit of bad debt, unfortunately, but no, it hasn't been something that we've dealt with that much.
That's good. All right, so let's talk about you've talked a lot about workforce and affordable housing, and you and I share for this. So, my personal view is that I think most investors, especially LPs, just don't fully appreciate the opportunity in this space.
Mm-hmm.
And I've shared the data before, but there's ample evidence now that middle-income housing is a win-win for investors, for communities, for renters. And so I know you kind of share this passion. So tell me, what are you seeing in terms of opportunity in this space, and particularly through these benefits, these kind of unique benefits of public-private partnerships?
Yeah, these public-private partnerships. Well, I mean, we've leaned in heavily to it as a firm. We're very bullish on what the outlook looks like over the next 10 to 15 years. We think we're in many markets around the United States undersupplied. I think what's fascinating, obviously we just had a big election yesterday, is how really and you mentioned this too before, Jay, is one of the first times we've seen, political president, candidates talk about housing, right? And talk about the need for more housing and creating plans for more housing and to create cheaper housing. And so what's actually unique is what we tell people is, if you think about it, we're here in Southern California where, Southern California Governor Newsom would tell you housing's a major issue. It's a huge part of his platform, bringing down the cost of housing, creating new housing. You go to a market like Texas, by the way, which is obviously from a political spectrum, you couldn't get a more opposite, sort of political landscape, where in California you have a supermajority of Democrats, Texas you have a supermajority of Republicans. Texas, many of the places we go to, Dallas, they will tell you we need more housing. We need to create more affordable housing, especially for our workforces. So this is somewhat of a universal issue across the United States that cuts through any political class. So I think that's the good news. And I think a lot of elected officials are hearing from their constituents that the cost of housing has grown so much, and they need to create ways to create more affordable housing. And so I think in this country, since we do it, we have, the LIHTC tax credit development program, which is great in terms of building affordable housing. Obviously, we would want to see more tax credits allocated, because it feels like, especially in a market like California, for every project that gets nominated, there's not enough credits to get them all done out at the same time. So, but certainly it's an avenue. Obviously, we have plenty of avenues to create market rate housing, but this workforce housing niche, right now it's still somewhat unknown, but we think it's going to be something that is going to increasingly be part of investors' portfolios, part of what, local housing authorities, city councils are looking at, is ways in which to create more workforce housing, because they're hearing it from their constituency. And so from our perspective, we kind of view it very similar to how student housing was viewed pre-GFC, where there was no student housing conferences, there was no institutional capital in student housing. But then through the GFC, people realized that was a great asset class. And now there's conferences, there's people who have to do it. We joke Blackstone is heavily involved in student housing. We see workforce very similarly, where we think these ideas of public-private partnerships, we can tell you these are only growing across the United States. They're not shrinking. We think LPs' willingness to look at these type of projects and look at the risk profile of these deals, recognizing the fact that in many ways, what we've seen through our portfolio, because we have almost 5,000 of these units, is you do see lower turnover. You do see, higher retention rates, because if you lower people's rent, generally they'll stay longer and they like it, right? You do see lower marketing costs. So we think this will be, over the next 10 years, an asset class that continues to get more and more defined. Now I think what's really important, one of the hard parts is, you hear the term workforce housing, there's so many different definitions of that. We really consider it projects where there's rent restrictions in place. So you're basing people's rents on their incomes. A lot of times it can be mixed income. But that's what we consider, and that's the space we play in. I think there's a lot of people who sort of use the term workforce housing, but it's really just older market rate housing. And so I think there's an important delineation there. But we're really bullish on the sector. We feel strongly that this is a sector we want to lean into. And again, I think as there's more and more data out there, specifically over the next 5 to 7 years, I think it's going to become more of a defined asset class. And I can tell you from the political perspective, on the ground, because we talk to a lot of different housing authorities and groups across the country, it is not something where people are like, we don't want to do this. In fact, it's the opposite. How do we do this? How do we create this? Now, some situations are more unique and have a greater ability to be able to do it. But in many ways, we think it's something that people are trying to find more ways to do it.
Yeah. No, I generally agree. I think the challenge that I've seen is more just helping educate people understand, hey, this is not a charity case. This is actually an investment case that will have a public benefit as well.
Correct. And if you looked at some of our projects, Jay, what you would find is, yes, you are giving up upside in workforce housing if you're deed restricting rents, because you're not going to charge, if the rents really grow in, let's say like Dallas, like they did in 2021, you're not going to get necessarily the benefit of that. However, from a downside protection standpoint, you'll get cheaper debt from the agencies. And again, we think your NOI will be more sticky
and stable.
For the reason I said. So we think from a risk-adjusted return standpoint, it's a smart investment, because going back to my Dr. Doom, if you chase those aggressive value-add projects, I mean, there's an upside and downside of that, as many people are learning right now.
Yeah, no, I think there's a very strong case to have affordable and workforce as part of a balanced portfolio for that reason. All right, so John, let's switch to a lighter topic.
Sure.
Let's talk about social media. And, I started posting on social media back in 2020 during COVID, and it was kind of a time frame when no one knew what was going on. And so just started, doing that, and had no idea it would take off as much as it has. And we got to know each other first through that platform, commenting on each other's posts, and you've grown your account. It's one of the biggest in multifamily across the country. So I'd love to know about your LinkedIn journey, how you got active, what benefits you've seen come from it.
Yeah. So it's funny because, LinkedIn to me pre-COVID was something I never really went on. And then I think, like a lot of things in COVID, I started going on it a lot more. And I saw a lot more people posting. And I think just people being at home or doing whatever, I think it grew in stature. And so I had leveraged it to just post about what we were doing as a company. And then, I mentioned you earlier offline, we were talking I teach at USC in the graduate real estate, the MRED program. And a lot of times, I give thoughts and different anecdotes to my students. And I know that they appreciate it and they liked it. But one of the things I always struggle with a little bit is you have to be at USC paying a lot of money to go to that program to be able to hear it. And when that whole Dr. Doom thing kind of came up, I thought, I'd love to be able to share more of what I'm teaching at USC and what I think about the markets. And let me just try it on LinkedIn. And that's really kind of when that whole Dr. Doom thing sort of started. I said, I'm just going to be honest about what I think and feel. And if people like it, great. If they don't. And what I found was a lot of people, it really resonated with people. And I think people have appreciated, my honesty and my authenticity. And I think me trying to, I have a real passion for helping the next generation of real estate professionals. So when I post stuff, I always try to do things, is this going to help somebody else? So I've done it organically. I haven't tried to grow, a following base. When I have a story or I think about something, I post it. I'm obviously, kind of like you, Jay, we can tend to be, take up the full amount of posts, and I can be a little bit long-winded, as some people tell me, and they say I need to
expand that word count on that
and all that stuff. And I'm like, look, I'm going to be myself.
Yeah.
And I think that's how it's grown in. I tend to be somebody who, you haven't met me in real life, but if you meet me in real life, I kind of say how I feel. But again, I think LinkedIn is a great platform to be able to share information where maybe somebody in some other part of the country who's thinking about doing something entrepreneurial, reads something that I said and helps inspire them, right? And, maybe somebody who's thinking about investing in a project reads something I said and they go, oh, maybe I should have invested, or here's what I think about it. So I just have a lot of fun with it. And I haven't taken myself too seriously on it. I just said, I'm going to post this stuff, and if people like it, great. If they don't. And the irony is, what I find with my posts, the more real and authentic I am, when I share some of my struggles, when I share problems that have happened, that's when I get the most likes. And so I think there's something to be said for that. And so that's really been my LinkedIn journey. I've been able to meet some really, great
Yeah.
people like myself. And I just think it's a great platform to be able to share information. I do think a lot of people misuse it and a lot of people post very self-serving type of stuff. It's why I always love your content, because it's great and it's very relevant and it's real and it's data driven. A lot of times I see people posting pictures out in front of a building, like, look at us, we're so successful. And I'm like, I would never do that. And I think the irony is I don't do that. And I guess maybe I get more followers because of that.
It's funny you mentioned this. I've had the exact same experience, which is that I never read a training manual on how to post on social media. It's just, like the genuine nature. People ask me all the time, it's like, oh, how'd you do it? The same as you. It's like, I post things that are interesting to me, and it just happens it's baffling to other people who are interested in the same thing. But it doesn't start with, hey, what's the algorithm gonna,
100%, right? And you and I think we said this once when we met in person. Like, I'm a real estate nerd. I love real estate. I love reading about real estate. That's why I love your posts, because you're data driven. And I feel like there's people like that are out there, but more importantly, you're very authentic. And so when people read your stuff, I think there's a sense of you're looking at data, you're making analysis, you're trying to provide, content that you find interesting. But in all reality, Jay, I think it helps other people. And that's what I always tell people about LinkedIn is the more you can think about LinkedIn, if you wanted to grow a following, thinking about helping other people, there's this great irony that the more you do that, the more followers you get. So if your goal is followers, you'll get more. But that's really it. I think there's also a lot of noise on LinkedIn and a lot of noise in the real estate markets. I try to cut through that a little bit.
Yeah.
And so, as I always joke, like, you go to a conference and people say something on a panel, then you have a cocktail with them, they say something totally different. I'm trying to give them sort of that cocktail conversation, especially for the younger generations, especially as they're going through their first cycle. They need to understand this is normal, what's going on. And so that's really the reason I'm doing it.
Yeah, no, I appreciate you and I are aligned on that. So, well, John, thank you so much for the time today. Really enjoyed it. And I'm sure our audience did as well.
Yeah, thank you very much for having me on. It was a lot of fun.
All right. Thanks again to John. That was a lot of fun talking with him. We got another great conversation coming next week. Fred Twomey, formerly Equity Residential, Colony American Homes, Starwood, Invitation Homes, now with Pretium. He has a very unique vantage point, having been part of the maturation and institutionalization of both the apartment industry through his time with Sam Zell at EQR to the SFR industry, helping really launch it with Colony America, Starwood, and then Invitation Homes. Now he's focused on how multifamily and SFR operations and asset management really come together in this role at Pretium. So I promise that'll be a fun conversation. You're going to learn a lot from Fred, and you'll get to hear some Sam Zell stories, and who can beat that? So join us again next week. Until then, thank you for making the rent roll part of your day.